Okay, hello everyone. So, this is exercise 8-11. So you're going to start with, it says record the transactions in the general journal. This company does not make entries to accrue interest except at December 31. So start with the first date, which is in 2016. So you'll do May 1st, 2016. It says received a $55,000 12-month 3% note in exchange for an outstanding account receivable. So you will debit the notes receivable account for $5,500. Then you will credit accounts receivable for $5,500. So then on December 31st, you will calculate the accrued revenue for this previous note. So first you'll do interest receivable, and then that account will be debited, and then you will credit interest revenue. So in order to calculate this 110, which I already plugged in here, you will take $5,500 and you will multiply it by 8 divided by 12. And you'll multiply that by 3%. So I got the 8 because you calculate this on December 31st. So you want to figure out how many months have gone by since May 1st, when they got the note, to December 31st. So if you do the math, it's been 8 months. So then you'll do 8 divided by 12, because it's a 12-month note, and that will tell you how much interest you've incurred at that point in the year and at that point of their note. So if you do that math, it comes out to 110. And so it's 110, both of these. And then it tells you that on May 1st, they paid that principal amount plus the interest. So you'll put May 1st, 2017, and then you'll do cash. And your cash amount is, we'll figure it out. I'll tell you how we figured it out. So the first thing you're going to do is your notes receivable. So notes receivable will be credited for the whole amount that was in there, which is $5,500. Then you'll do interest receivable, and that will be credited as well, because they paid all of the incurred interest, which is $110. And then you want to figure out how much interest they have paid since you last calculated it. So that would be December 31st. You calculated the interest, and you want to calculate for the months of January, February, March, and April. So that's 4 months, so you'll do, again, $5,500 times 4 divided by 12, because that's 4 months, times 3%. And that comes out to $55 of interest that they've paid since you last calculated it, or that they will pay. So you'll put $55 over here in the interest revenue account. You'll credit that account. And then you'll add the 55 and the 110 to the principal amount that they owed, which is $5,500. So all three of these, if you add them up, is how much they're going to pay, which is $56.65. So again, the way that you find interest is by taking their principal amount, which is $5,500, multiplying it by the amount of time that it's been so far. So on December 31st, it would have been 8 months, so 8 divided by 12, and multiplying it by the 3% interest rate. So that will give you the 110. And down here, you'll figure it out by saying, okay, since December 31st, there's been 4 months to May 1st. So you'll do, again, the $5,500, the principal amount, times 4 divided by 12, because it's been 4 months of their 12 months, and times 3%. And that is your $55 right there. And then, because they paid their principal amount plus all of their interest, they will end up paying you $56.65. Alright, hopefully that makes sense. Good luck.